Well, hello there, and welcome back to Finspire's Focus on the Market series, third quarter 2021 edition. It's good to have you again here today. I'm Chris Karam, Chief Investment Officer with Finspire, and we're going to walk you through what happened in the first half of the year and give you a look ahead for the rest of 2021 and 22 and beyond. This quarter's theme was the Rodeos and the Sleeping Bear. As you know, we always like to have a little fun with these, and the Rodeos were really a great time when I was a kid, visiting the local fairgrounds, getting a chance to see all the cowboys and the horses and the bulls in action. And then the other picture, the sleeping bear, we're going to have a little fun with that because actually the picture at the bottom right is another wonderful summertime activity, especially here in the Midwest. If you get a chance to go visit the Sleeping Bear Dunes in the northern part of Lower Michigan. But we're also going to have some good visuals of actual sleeping bears later on in the presentation. So as you might imagine, the metaphors of using the bulls and the bears is right with us. We're just going to have a little fun with it along the way. As always, we share economic and market facts and mixed in with some of our opinions about what's going to happen looking forward. So let's get into it. First, U.S. economic growth. We have been on a tear. So first quarter GDP growth came in at 6.4%. It is quite possible that for the year 2021, we may end up surpassing 7% overall economic growth for the whole year. And that would be a booming number. And a number you can see here we don't see very frequently, especially in the last 4 to 5 decades. Now, what's driving that? Well, it's not just manufacturing activity. And a lot of the manufacturing activity has been related to inventory rebuilds of goods that are on the shelves for us to purchase, especially as demand has increased, but it's also in services. So we see that with the TSA line. We see that with restaurant activity, all surging to pre-COVID levels. And so you can see these expansionary figures are numbers that we haven't seen in over 20 years. And that ties right in with the way we're going with our leading economic indicators. The series of leading economic indicators have catapulted substantially higher from where they were when they bottomed out in the recession, the COVID-related recession of the springtime of last year. And you can see the current levels of the indicators are at levels we haven't seen in 50 years. So what does that mean in the capital markets? So when we take a look at asset class returns, this is our very popular stacked chart here of top performing asset classes to bottom performing year over year over the last 15 years. And in 2021, you'll see that small cap equities have led the charge at 23.6%. Interestingly, in position number 2 there is the commodities marketplace. We're going to talk a little bit more about the surge in commodity prices and how that relates to inflation. Right behind that is the S&P 500. Hey, a 15-year, 15.3% return in the first 6 months of the year is a great year in its own right. We'll see if it can sustain itself. We'll talk more about that in a moment. International equities have trailed, certainly trailed year to date, although still substantially positive in the first 6 months of the year. Fixed income is what's trailing. So the bond market, the bond index, I should say, is down 1.7% in total return, even after yields fell in the second quarter, which we'll talk about again here in a moment. All right, so just to give you a sense of the magnitude of the strength of this equity market, we have yet to see 5% or more pullback in the S&P 500 since the start of the year. You can see the last time that happened was 2017, but on average, we experienced 4 to 5 different pullbacks of 5% or greater on the S&P in any calendar year. So it has been that kind of year. The first 6 months were a pure bull run in that equity market, nothing to lasso it back. We've also seen a rotation, a sector rotation. Last year was such in favor of the technology sector. As soon as the vaccines kicked into gear, we saw a big rotation towards financials, energy, industrials, and materials sectors. And you can see big changes in returns year over year across those different sectors. And this market is not only growing, but it's also rotating towards those value-oriented sectors, a little bit away from growth. But I will say that when interest rates came down here, especially in the month of June, we saw a resurgence in strength in the tech sector because those stocks tended to be more sensitive to rises in interest rates than like we saw in the first quarter of this year. Okay, let's look at what's happening in the labor market because it is interesting. As a matter of fact, we saw the labor force participation rate perk back up to 61.5% in the last couple months worth of labor market data. Now, what you can see there is a big sharp drawdown in the year 2020. Not too surprising during the COVID recession. We had that. We've gained some of that momentum back, But it's interesting. There still is a little bit of a gap between where we were pre-COVID and where we are today. Some of that we think is attributable to certain jobs not being there in this post-COVID environment. We also see some people took early retirements. So if you were someone who was approaching or near retirement pre-COVID and said, look, I'm going to give this another 2, 3, 4 years before I actually retire, perhaps the health scare and the economic recession coupled with a rising stock market in 2020, perhaps many people who are approaching retirement said, you know what, now's my time. Time will tell. So this is something we're going to look at real closely as the labor market continues its recovery. To give you a sense of the labor shortage, however, that's out there, you can see here from the JOLT survey, the Job Openings and Labor Turnover survey that the Bureau of Labor and Statistics provides. We have over 9 million job openings, but according to those labor force participation statistics, only about 4.5 million people that are really in the labor pool currently looking for work. So this gap, we have a job gap that really needs to be addressed so that we can sustain some of our economic momentum. And with more people working, with higher stock prices, with more money flowing in, especially from government stimulus packages, we see earnings, company earnings really surging. You can see here at the top right of the chart, we've experienced essentially a U or V-shaped recovery in corporate earnings. And corporate earnings are really what drive future long-term direction of stock prices. And so with earnings prices or earnings on the rise and earnings per share on the rise, you can see why the stock market has been so supportive and why we haven't had those 5% pullbacks or more like we typically would see in any particular calendar year. Okay, now let's talk about the sleeping bears. And let's start with interest rates. So you can see this guy sleeping here on the stone. One is interest rates. You would think that if we have a rising tide in the economy, a rising tide in the equity markets, that we would have rising bond yields. That typically is how it works. However, in the second quarter, we actually saw a reduction in yields. In fact, the 10-year yield went from 1.74% to 1.45% during the quarter, which actually boosted total returns for fixed income in the second quarter, even after a very poor showing or rising interest rate environment in the first quarter of the year. This is a bit confounding. Now, what this tells us, just like the equity market is very forward-looking as it relates to earnings, the bond market is forward-looking as it relates to forward-looking economic growth, forward-looking inflation indicators. And in both of those circumstances, even though inflation and economic growth are both at elevated levels, it is anticipated. The bond market is telling us that we are going to see those levels taper off. Although still positive, they are going to taper off in 2022 and 2023. We'll get into what if they're wrong in a moment, but this is the way, this is what the yield curve is telling us right now, that this growth and this inflation that we're experiencing in the economy will taper down as we enter into 2022 and beyond. However, consumers are feeling it in the wallet. Now, if you can see here, two measures of inflation. First is the consumer price index, and this is very much a sleeping bear, right? Don't poke this bear. We don't want to continue to see escalated prices at the pump. We don't want to see escalated prices at the grocery store. But right now, or in wages or in rents, for example, right now we're getting that. However, the reason why the Federal Reserve and other economic prognosticators feel like this is going to be the term they use is transitory, they feel like it's going to be short-lived, is because if you look at this rise in the consumer price index, it very much resembles the one we encountered in 2009 when we were coming out of the financial crisis and Great Recession of 2008. So that is to be determined. But there's another way to measure inflation, and that's the producers, the manufacturers of goods and services. The cost for them to make those same things between this time and a year ago this time is substantially higher. And eventually those producer prices, when they are elevated, tend to trickle through right to the consumer, and that could spur higher levels of consumer prices as we look in the second half of 2021. This is something that the Federal Reserve is going to watch with very, very closely and with that eagle eye. They do not want to see inflation spiral out of control because that means they have to raise interest rates much sooner than they anticipated. All right, the last sleeping bear here. We got a double sleeping bear, and that's tax rates. We have two forms of tax rates that are really under the microscope of the Biden administration and and in Congress. Congress is contemplating changing both the corporate tax rate and potentially the personal the corporate tax rate and also potentially the capital gains tax rates after they were reset in 2017 under the Trump administration. It's very popular, very common for the first year of a presidential administration to tackle taxes and spending. The Trump administration used to have took the corporate tax rate from 35% down to 21%. The Biden administration is thinking about raising that back up to somewhere at 25 or 28%. We'll see what gets through Congress. But the other area is capital gains taxes. Capital gains tax rates are also poised to rise unless there's a complete gridlock in Congress, which is completely possible. So expect tax rates and spending bills like the infrastructure bill to be top of mind both before the August recess in Congress and after the August recess all the way through to the end of the year. Remember, in 2017, the Trump tax rates those bills were not passed through Congress until the late December of 2017. So this could be a really contentious debate, like it always is, but this one could be a real contentious debate right up to the end of the year of 2021. All right, so let's summarize. As we look at the first 6 months of the year, we've got a surging economy, and we've aided by very successful vaccination and inoculation campaigns coupled with government stimulus. It has fueled an entire amount of demand that is creating an economy that could surge 7% in 2021. The labor shortage is real, and we're going to need to see significant job growth for the next few months, not only in the monthly jobs figures, but also in that labor force participation rate to see if we can close that jobs gap that exists today in the economy. Earnings growth has been very supportive of stock prices, even as sector leadership rotates, and that earnings growth really is the lifeblood of future asset prices in the equity market, and we look for those to continue moving higher. Inflation is the wild card. The Federal Reserve is looking at it real closely. Yes, it looks a lot like 2009 right now, but if that continues and those rates of inflation continue to rise, the Federal Reserve may be surprised and it may force them into activity that they may not want to do, like raising rates sooner than anticipated. Watch for a contentious congressional session. It is going to be taxes, spending, infrastructure, and a rarely used process called the reconciliation process, which would be a really contentious debate where you don't need 60 votes in the Senate to pass budget-related taxes and spending bills using that process, and you're going to hear a lot about that in the second half of the year. Finally, enjoy your summer. This is unlike last year where you couldn't get out and about. Please do so. Hopefully you get a chance to either visit a rodeo next to you or visit your own version of the Sleeping Bear Dunes, and where you can enjoy your peace and enjoy your family and enjoy the summer. Thank you so much. We'll talk to you later this quarter for our mid-quarter update, and then again in the fourth quarter as we put a wrap on 2021. Thanks for joining us. We'll talk to you soon.